Great. So once again, welcome you all to the revision section, 2021 Performance Management and Management Accounting. That is F5 and paper 2.2. We're going to look at the cost room profit analysis, also known as CVP or break-even analysis. That is the agenda for the day. Let's see. We call it cost volume profit bracket CVP or break-even analysis. That is the agenda for the day. So at the end of this, you should be able to understand this in details to the extent that any question that they ask you, you'll be able to answer it in the exams. Okay. Now, break-even, I also call it what if analysis. That's the name that I've given to it. So let's add it. It's also called what if analysis. What if analysis? That's the name. I'll explain why I give that name out. Now, when we talk about break-even, before I explain, let's just perform small exercise here to understand the concept behind break-even. Now, let's assume that our selling price for a particular product is 25 cedis. The variable cost happens to be 20 Ghana cedis or $20. What will be the contribution per unit? If the selling price is 25, variable cost 20, contribution will be what? Okay, so contribution per unit will be 5 cedis or $5. Okay. Now I can ask you these three questions. Let me add one more item. Fixed cost. Let's also assume that this company, their fixed cost is nothing by just 1,000 cedis. That's the fixed cost, 1,000 cedis. Now let's perform small exercise. Small exercise here. Prepare operating statement when the company produce and sell the following units. First, when the company A, when they produce and sell 2,000 units, B, 5,000 units, and C, 7,000 units. Great. So the question is required. Prepare an operating statement, that is profit statement, for the following units or for the following activity level. So that's the question. Using this data, prepare an operating statement or profit statement for the company for the following activity level. So the activity level A is 2,000, B is 5,000, C is 7,000. So here we are saying that the company selling price is 25. Variable cost happen to be 20 Ghana cedis. So the contribution will be 5 Ghana cedis per unit. Then the fixed cost happens to be 1,000 Ghana cedis. So the question is, or the requirement is prepare an operating statement if the company produces and sell 2,000, 5,000, 7,000. When you are done with this, I'll use the solution of this to just answer or define or explain break-even analysis. And in that, you grab it. So I want to touch the board again and produce a solution for this requirement. And we use this to explain break-even, the actual meaning of what break-even or CVP analysis. Cost volume profit analysis or break-even analysis. Okay, so let's start again. So I tell the examiner that I am starting with the operating statement. So operating statement, which is same as what? Profit statement. How do you prepare profits income statement? And break even, I want the heading to be like this. Here, when they produce 2,000 units in column form, 2,000 units. Here, when they produce 5,000. Then finally, when they produce 7,000. Okay. That is how I want the solution to be. Now, let's bring our currency. We are reporting in Ghana cedis. We could also report in dollars. The sales. What will be the sales? Now, we are assuming that when they produce and sell 2,000 units, right? And that's order. So if it is 2,000 units, what will be the sales revenue? Selling price is 25 cedis per unit. So therefore, 2,000 by 25, answer. That'll give us something like 50,000, right? Okay, so this is 50,000. What about when they produce 5,000 units? So that'll be 25 by, so 125,000, right? Then when they produce 7,000, then we get 175,006. Okay. Now, what will be the variable cost? Variable cost will be 20 by all of this. So this will give us 40,000, right? That's 40,000 then. Okay, so 40,000. 50, 100,000 and 140,000, right? Okay, 140,000. 140,000. I just make small changes with the fiscal. Now, what will be the total contribution? Now, this will be 10,000, and this will be 25,000. Now, I'm just assuming, I just make small changes here. Let's assume that the fixed cost is 25,000. That's all. The fixed cost is 25,000 units. So 25,000 cedis or dollars. So that's the fixed cost. So the contribution, let's record the contribution, total contribution. Here will be 10,000. Over here, 25,000 and 35,000. Then we record to get a profit is a contribution less what? The fixed cost. Good. Here we are using the marginal costing approach. So therefore, I bring the fixed cost here, which is 25,000 throughout. Can you make that 10? 25,000 throughout. And we are subtracting the fixed cost, right? It was the net profit or profit for the year. Net profit. Okay. Now I can take off this section because you do have the question there. Copy the question, so it's going. So what will be the net profit here? A loss of 15,000, right? Good. And here profit of 0. And then profit of what? 15, 10,000. Good. Okay. So that is. Now, when we talk about break even, the word break even simple means break even. It means where your total revenue is equal to your total cost. And for that matter, profit is equal to what? 0. That's the implication. So at break even, you are not making profit, you are not making what? Loss. Your revenue is exactly the same as what? That of your cost. So revenue is exactly the same as your total cost. Good. So tell me, which of these activity level the company experienced break even when they produce and sell 5,000 units, right? Good. So this is what we call the break even point for this particular company. Now, when you talk about cost from profit analysis and break even analysis, when you talk about CVP analysis, here we are analyzing the changes in the volume. The word volume means output units in management accounting. When we mention volume, we are referring to what? The quantum, the quantity of unit that you are selling or producing. Good. So when we say CVP, we are saying that changes in the volume of what? Output. How does the changes in the output affect the following? 1, affect cost. 2, affect revenue. And finally, affect your profit. That's all. So if you are analyzing the changes in the volume of the output, its effect on cost, revenue, and profit, you are conducting what? CVP analysis. You are doing cost, volume, profit analysis. You are analyzing the changes in the output. Good. So it's simple answer the question like, what if you produce 2,000? What will be your profit? Negative 15,000. What will be the cost? Your variable cost is 40,000. What is the sales revenue? 50,000. Okay, good. What if you produce 5,000? What's your total profit? 0. What's the variable cost? 100. What if you produce 7,000? So that's why I personally call it what if analysis. So I'll not be surprised in the years ahead of us, you see them referring to what if analysis. Don't be surprised. So break-even analysis simple means we are analyzing to see the effect on profit, cost, and revenue with the changes in what? Output. So if you produce 10,000, what will be the profit? If you produce 5,000 units, what will be the profit? If you produce this, what will be the profit? That is all about CVP. Great. So with this short exercise, we've looked at the various changes that the variable cost will go through with respect to what? That of the changes in the output. We've seen that when the company increases to 5,000, the sales revenue also increased to 125,000. Likewise, the variable cost. However, the fixed cost is the same, right? Because it's fixed. Great. So that is how it went. Okay. Now we can just present the information and just ask you to calculate the break-even unit for us. You don't need to go through all this. Now break-even come with a lot of assumptions. So let's look at the assumptions of break-even. Before break-even works, there are quite a number of what assumptions. You have to Know these assumptions. Second, anytime the examiner asks you the limitation or challenge or disadvantages of break-even analysis, tell the examiner that in reality, none of the assumption is true. So quote all the assumptions one after the other and just add the last sentence. In reality, it's not true. And I'll explain why in reality the assumptions are not true. Good. You know, what is true in a book is not the same as what is true in reality. Yes. Life has its own dimension from what you learn in the book. Let's look at the assumption. Assumption number one. It assumes that production is equal to sales, and therefore the company keeps no inventory or little. So no closing inventory. That's the first assumption. Or you can arrange it anyhow you like. And make sure that you get like at least 5 assumptions. Production is equal to sales. And therefore the company keep no inventory or little. No or little inventory. No or little. So that's the first assumption. The company keeps no or little inventory. Or production is equal to what? Sales. No closing inventory. No. No closing inventory. Is it true in reality that you can sell what you produce? Definitely there'll be some leftover. Yeah, so in reality it's not true. Company keeps inventory. So when it's asked for limitation, that is in reality it's not true. Point number two. Yeah, this is not true because companies keep what? Inventory. That's all. You can even not bring the reality there. Or this is not always the case because in certain period, company keeps what? Inventory. Yes. Because normally companies produce a lot in their bumper seasons and then hoard it in the certain seasons and release them, right? Good. So they keep inventory. Now, point number two. It assumes that the selling price and the variable cost per unit remains constant or the same at all levels of what activity. It assumes that the selling price, let me see if I can just point down. It assumes, so point number one, no closing inventory. Closing inventory. Point number two, it assumes that selling price per unit, selling price and variable cost per unit. So selling price and variable cost per unit remains constant at all levels of activity. Remains what? Constant or the same at all levels of activity. Remains constant or the same at all levels of activity. That is the same assumption. And that's what we saw here. The variable cost, selling price was 25, right? And the variable cost was 20. At all levels, we are multiplying by 25. This, when they produced 2,000, the selling price was still 25. When you produce 5,000, still the selling price was still 25. In reality, is it true that the selling price will be the same at all levels? No. Due to inflation, that is another due to inflation, selling price was changed with respect to the unit produced. And you know, customers' reaction. When you produce more, when you produce more, what happened to the price? Now, it means that when the selling price increases, that means the production must drop. Good, because now customers or consumers will consume later. All these ones must be taken into consideration. Good. Likewise, the variable cost. It's also saying variable cost is constant. So in reality, it's not true. Variable cost probably also increase due to the level of inflation. Point number three, fixed cost. It's also assumed that the fixed cost remains constant. The fixed cost remains what? Constant at all levels of our activity. In reality, it's not true. Fixed cost can also what? Increase or change. In short, the fixed cost will be the same toward the activity level. Now, this CVP analysis, it's a major topic under, it's found under marginal costing. It's found under marginal costing. Then point number 4. It assumes that cost can only be classified into two. It assumes that cost can be classified only into two: variable and what? And fixed. That's what it's saying. So that's what you can see here: variable cost and fixed cost. Variable cost and fixed cost. In reality, it's not true. Cost can be semi-variable, it can be step up, and any other that we cannot even determine the relationship. Point number 5. It assumes that, point number 5, it assumes that the variable cost and the sales revenue have a direct relationship or a linear relationship with that of the output or the unit produced. It assumes that the variable cost and the selling price have a direct relationship or linear relationship. Direct or linear relationship. This one reality with output or quantity produced. With output or quantity. Here too, in reality, it's not true. Good. Final one. It assumes that past information will provide a reliable guide in future. It assumes that past information will provide what? A reliable guide in future. That is the assumption. It assumes that past information will provide what? A reliable guide in future. In reality, it's not true. Nothing suggests that in 2019 and 2020 we have COVID. There was no information in 2019 that suggests that COVID will exist. So, what has happened in 2019 does not mean that history will repeat itself. No. History sometimes do not repeat itself. Now we are done with assumptions. Let me give a trial work. Give me 5 importance of break-even analysis or 5 uses. I think this question I've asked it in the material. So question 1. That means you are trying every aspect of question 1 with the tutorial questions. Question number 1. Let me see if I can project it on the screen for you. Okay, so question 1 is the trial work in advance. Everything about question 1. I like the C. Question 1C. Briefly discuss the importance or uses and the limitation of our CVP analysis. I need 5 points. Can you raise 5 points for me? And then the B. Discuss the main objectives of the CVP analysis. I need that one too. That is all. Now the CVP with the CVP, we do have it's in single product and then multi-product. In fact, one of the assumptions, let me even add it to it. Deal with a single product and multi-product. Let's go to the assumption. Let me add one last item to it. The assumptions of the break-even. It also assumes that the company produces and sells only one product. So it also assumes that the company produces and sells only one product, comma. This is a pregnant assumption. So we down the first point. It assumes that the company produces and sells only one product, comma. In a period of multi-product or multi-unit, the sales mix remains constant at all levels of activity. In a period of multi-product or multi-unit, the sales mix remains constant at all levels of what activity. That is the assumption that we are adding to it. In a period of multi-product or multi-unit, the sales mix remains constant. Is it true in reality? The first one says that they will produce only one product. No. How can company produce one product? They want to be strategic. So they should have several products. If one is in one, probably will not do well, and then they will still win. So we are saying that the company produces only one product. That's the first point, and we say that it is not true. Then the same point, the latter part says that in a period of multi-products or multiple products, the sales mix remains constant. Sales mix remain constant. Now, let's assume that we produce duster and marker. Sales mix means if I produce or if I dispose of 4 markers, 1 duster should move. That's a sales mix and it's constant. So if I sell 1 duster, before I sell one again, I have to make sure that I've disposed of 4 markers before I come and sell another duster again, 4 markers. You know, it is true that you have to dictate on what the customer should buy. No, if the duster is what they want, they'll buy the duster and leave the marker. So that's why I'm saying none of this assumption is true in reality. So that is it. Now, we are about to start the actual game. When you pick break even, we have single products and we have multi-products. So we will start with the single product first, where the company produces just one product. So for now, all what you're going to solve, all the questions we are solving is on single product. Single product. And please again, break even is 2 things. Number 1, formula. Number 2, analysis. That's all. It's 2 things. Formula versus what? Analysis. Because the thing is break even analysis. So that analysis, we can't do CVP. So we should take note. What if this one changed by this? What if we add this one to this one? What if it's like this? So that's why we call it what if analysis. Okay. That's all. Now we will start by break-even point. I don't want to clean this one because we are going to use formula to produce all what they've done here. The long approach, we are going to use formula. So can we take note? So the first formula that we are going to look at or the first point is number 1, break-even point. Break-even point. That's the first one under the single product. So break-even analysis under what? Single product. So break-even single product. Break-even point. Now, this is the point of production and sales, or this is the activity level where the company makes either profit or loss, or the company total revenue is equal to total cost, profit is equal to 0. At what point? Now, for those of you who have done mathematics before, in fact, I was told everybody have done mathematics. Yes, learn something like point on a plane geometry, right? Every point on a plane geometry have how many coordinates? They have 2 coordinates, right? X and Y. Good. How we get it? So it is that point 2 will also have 2 coordinates. So break-even point, we are just asking for 2 items. Number 1, break-even units. So that's the first item. Break-even what? Units. Good. Then we look at break-even value. So break-even sales value. Sales or sales value. So the question will move like this. Determine the units that the company must produce and then dispose of in order to break even. That's the unit. Determine the sales revenue. That will let the company break even. That is sales revenue. So that's the value. That is it. Each of them have its own unique formula. So break-even sales. Let's start with the break-even unit. It's equal to almighty fixed cost over contribution per unit. That's all. Fixed cost over contribution per unit. And then the break-even sales value, for now, let's maintain it at this for now. Even though later studies will come out with second formula. Break-even sales value is equal to the break-even unit times the selling price. That is it. Times the selling price. That is all. So let's see this question. Let's see this question, the one that we solved. First, we had a fixed cost of what? 50,000 or 25. The fixed cost for this question was 25, right? The contribution per unit was what? 5. Okay, so we can find what? The break-even unit. So therefore, the break-even unit is equal to 25,000 divided by 5 Ghana cedis. So if I divide this, I'll get something like, that'll give us 25 divided by 5, that's 5,000, right? So the answer is 5,000 units. So let me write it somewhere here. So that's 5,000 units. Okay. Now find the break-even sales value for me. So that means when a company produces 5,000, they will break even. They will make profits. Their profit will be 0. No profit or no loss. What will be the break-even sales value or the sales revenue? We say the break-even unit times what? The selling price. So multiply this 5,000 by the selling price of 25. So that will give us 125,000, right? Okay. So that will give us, as you go down again, now this one will give us 5,000 times 25 cities, and that will give us a city of 125,000. Now what do you see here? This is the solution. This 5,000 is what the examiner was giving to us. This 125,000 is this one. That is all. So without this, we can look for the break-even. Now, the examiner just said that we should prepare a profit statement if the company produced this, it was coincident that one of them gave us 0. So it means that in reality, if we should go by this approach, you do until your paper is exhausted because you are picking any unit at random. The one that will give me 0 profit, that's a break even, right? So that one, it can go, you can work, you won't get it. But the formulas work perfect. So that is it. Now that I can take this one off. So that's the first formula. I'm just going through all the formulas. We are done with break-even point. When the examiner asks for break-even point, please and please again. He is looking for the break-even units and what? Break-even sales value. So take note of that when the examiner asks for that. Then the next item is what you call break-even at target profit. Break-even at what? Target profit. So that's the next formula that we have to look out for. B, break-even at target profit. Break-even at target profit. Or, in fact, the real name is like this. Level of activity, the bracket unit, or sales to earn a target profit, target or required profit. Required profit. Take this. But this is how the examiner will put the question. So determine the level of units or sales to earn a target or a required profit of, then you put it there. That's all. So let's update this particular question that we are solving. Let us know the company wants to achieve a target profit of 30,000 cities. So let's assume that target profit is what? 30,000. Target profit or desired profit is equal to what? 30,000. How do you determine the units? So the question is, what should be the units that the company must produce and sell so at the end of the day they can achieve a profit of what? 30,000. Now with this particular question, we can use a long approach. But don't worry yourself. Let's go by the formula, right? So the unit required will be like this. We start examining unit required is equal to, so the fixed cost plus the target profit all divided by the contribution per unit. That's all. Now make sure that this profit here is profit before tax, not for tax. I will work it out when they have given us profit before tax or after tax. How to work back to get a profit before tax. Okay. So in this question, how do you provide solution like this? So let's do substitution. Again, the same question. The first cost happened to be 25,000, right? Plus target profit of 25,000 plus 30,000, right? All divided by what the contribution per unit. So the contribution per unit is 5 Ghana cedis. So therefore, what will be the unit? 11,000. So when they produce 11,000 units, they'll get a profit of 30,000. That is what implies. They'll get a profit of what? 30,000. Okay. Now, have you seen I did not mention tax? So I've solved it as it is. They've not mentioned tax in it. Okay, great. Great. Now let's continue the game. What if this profit is profit after tax? What if the profit given to us is target profit after tax of 30,000, and you have to give us the tax rate? Let's assume that the tax rate is 25%. Tax is equal to 25%. That's all. Now the issue is this. We are saying that this profit, whatever be the case, must be what? Profit before tax. When they bring issue of tax in it, then we are interested in what? Profit before tax. If they've not mentioned issue of tax, just work with it like that. Don't cause trouble for yourself. So now, if profit after tax is equal to 30,000 and the tax rate is 25%, start with what is the profit before tax? So if profit anti-tax is equal to 30,000 to this, and tax rate represent 25%, what is the profit before tax? Start with. The person will get correct to be the accounting kaka for the night. I'll use 3 different approaches to get it. But the answer is 40,000. But I'll use 3 different approaches to get it. The issue is this. Before I solve this question, let's test ourselves. Elementary. Let's assume that you are doing profit and loss. If you somewhere, your profit before tax happen to be just 10,000. Your tax rate is, let's say, 20%. I'll not choose the same figure so that you see the answer. This will be 2,000, right? We take it off. This is the tax. Let me do what? 8,000. And this profit after what? Tax. So the question is this. If I have given you this profit after tax, 8,000, and I've given you this tax, how do you then determine this figure, the profit before tax? That's why I said that the profit before tax must always be more than what? The profit after tax, because tax will not be subtracted in it. So now this one, find any ways to get this 10,000. If you want to get this 10,000, fine. With the help of this 8,000 and this 20%. Use any ways, any means to get this 10,000 back. Now it's like this. I'll give a long approach and short approach. To get a profit before tax, start like this. Profit after tax. Profit before tax is always 100, right? And then the tax is what? X%. Here is 20%, right? Okay, so therefore, profit after tax will be in percentage wise 80%. Agreed. So tell the examiner, if 80% this profit after tax is representing 8,000, then 100%, which is the profit before tax, will be what? Is equal to question mark. And then you try it. How we get it? Then you try that. That's the one way. Let me just give you the shortcut and then move on. The shortcut is that just pick your calculator. Tell the examiner that what are you looking for? What I'm looking for is 100%. Agreed. Profit before tax is always what? 100%. So pick it like this 100. Divide it by what you have. This 8,000 given to you is representing net of tax. So if tax is 20, net of tax is what? 80. So divide this one by 80 times what you have. Have the 8,000, right? So by 8,000. And this will give us 10,000. So apply the same approach to solve this and give me the answer. Because this, I'll not do it, you do it. So anywhere you're looking for profit before tax, this is how you have to look. Or sorry, it's what you get. It's 40,000. Good. So that is it. I'll also show you shortcut. Another shortcut. Shortcuts are coming plenty. Eh? So here, profit after tax is 40,000. So that is it. Let me do this all over again. Now, where they are taxed, the unit required formula can be expressed like this. Unit required is equal to your fixed cost plus your target profit all divided by 1 minus the tax rate all divided by what? Your contribution per unit. So it means that profit before tax is also equal to your profit after tax all divided by 1 minus T. That's all. So in this question, what's the profit after tax? 30,000, right? Divided by 1 minus 0.25. That's all. 1 minus T. This 1 minus T represents what? The profit before tax. Yeah, T the tax rate given to you in the question. T is the tax rate given to you in the question. T is the tax rate given to you in the question. Where T is the tax rate given to you in the question. Oh, sorry. Top wasn't coming. Where T is the tax rate given to you in the question. So, profit before tax. This will give us 40,000. So you can calculate it somewhere and put the answer in, or you can just do it straightforward. If the complication will not be too much on you, you can go straight forward and put it in. So now let's put everything in. The first cost is 25,000 plus 30,000 divided by 1 minus 0.25, all divided by 5 Ghana cedis. What is the answer? So take note when they are moving you between profit after tax and profit before tax. But if the question is silent about tax, please, it will just also be silent about it and then move on. Ideally, we are looking for profit before tax. Okay, so you get 13,000. So that was the answer. Great, so 13,000. Wow. First online had it long ago. So 13,000 units. Perfect. So that's the units. Now, the same question. Let's assume the company, 2 scenarios. Now, A, you are doing it too. They want a profit after tax of 25,000, where tax before I go to the question, let's solve this mathematical. So this one is nothing by 25,000 plus 40,000, right? Over 5. So it's still 13,000. Now you are trying this. A, the company wants profit after tax of 25,000 where the tax is the tax rate is equal to 33.18%. B, the company wants a target profit before tax. So let me write it here. Profit before tax. Before tax is equal to 40,000. No, it's equal to 60,000. Where tax is equal to 12,000. That's all. You are solving these two. So in each case, tell me the unit required. Start work. The profit after tax 25,000. Not 2,500. 25,000. Okay, so let's do it together. The first answer is around 12,000. Yes, that's going to be around 12,000. That is the correct figure. So I just have to claim for the A. I'm solving A. I just have to claim this figure here and just put in 25,000. All divided by 1 minus 0.33. Make the 3 4. Because 33 1/3 simple means 33.33%. Yeah, the fixed cost is 25,000. So we solve a systematic order. What's the profit before tax? Profit before tax, it should be around 37,000 going. Then you add 37 to 25,000, which should be 60 something going. Then you divide it by 5, which should be 12 something going. So here the final answer will be 12,000, which is equal to 12,482 or so. 12,400 okay, 496 units. Now let's see. Let's look at the B. B, the answer is straightforward. This is 60,000. I'll be sorry. Yeah, the answer is straightforward, right? So what do you get? Right. Okay. So with the B, can we go to the B? So let me clean. Perfect. I'll take that. So let me clean the A and go to the B. The B. We need a profit before tax, right? And they have given it to us. So we go straight forward. First cost was 25,000 plus profit before tax of 60,000. I don't need to worry myself with tax. All divided by what? 5. That's all. We are interested in profit before tax. So if it's given to us, there's no need for us to worry ourselves again, to look for it again. Yes, even if I confuse you and say tax rate is still X, and the tax rate was 20%. Okay, so 20%. All these ones are irrelevant as long as this information is there. What if I give profit after tax of 48 and I give you tax of 12,000? What will you do? Okay. Okay, we are looking for profit before tax. We are looking for profit before tax here. So the issue is whichever system, whichever way, we have to make sure that we get a profit before tax. Just add. If you add the two together, you add profit after tax plus the tax goes up. You get a 60,000. It's the same question now. I've reversed it. So you add back. So this one gives us the profit before tax, and that is what we are interested in. In all cases, kindly look for the profit what before tax. Okay. So this one answer will be 17,000, right? Good. So we are done with break even at target profits. Now let me move on to the next item. The next item is called margin of safety. Margin of safety. Margin of safety. The next one is margin of safety. Margin of safety. Okay. Now let's see. Take that. Now, for purpose of your exams, because that thing is a formula work, how to get a profit itself, or how to get a fixed cost, or how to get a contribution per unit, it will be a challenge for you. But you know that if you make it free like that, just pick it and put it in, right? And so after we are okay with the formula, after you're okay with the formula, we're now going to it how to look for those items, how to massage them. That is all. I can assure you that you can get a straightforward question where I'll give you everything and ask you to find a meaning. You know, do that. We'll give you a statement, ask you to adjust certain figures. At the end of the day, what's the margin of safety? Great. Okay. So the next aspect is called margin of safety. Let me ask you this beautiful question. Now you are production manager of target communication. After this, not even after this, you are production manager. You know that when we produce our best-selling book to ICA and other universities in the country, the break-even unit for this question happened to be what? What was the break-even unit question? We had 10,000, 5,000, right? Good. When we sell 5,000 copies of the books before we can break even, so the profit, let's write down here, this is the profit. This what it tells us, this is a unit, this is a profit. Now, when the profit is there, the unit, each corresponding unit is break even. If you produce less like this, you get loss. If you produce more, you get what? Profit. So these sections are just your profit or loss. This is your unit. Okay, so the question is, now you are the production manager. You are responsible for number of units that you need to produce. So tell me, What unit? If you are paying a budget, will you budget to produce 4,000, which is less than 5,000, where you get loss? Or you budget more than 5,000 to get profit? Which one will you do? More than 5 to get profit, right? Okay, good. You're a good production manager. Let's answer the second question. What will be the value? Any figure at all. So what will be your budget? Let's assume the budget is what? Just 6,500, right? Okay. So it means that you added certain units to the break-even, right? You added what? 8,500 is called margin of safety. You are free, so you put safety in of 1,500. So in the event where worst case scenario occur, all what you have to do is we can hit our break even and then will not be affected. Now, this is a concept of what? Margin of safety. So this is your budget. So this one, call it budget. Call this level budget. Call this level break even, right? So what? How do you find this 1,005? Who can drop the formula for me? Who can drop the formula for me? If this is break even, this budget, and now they are different, 1,005, then how do you derive a formula for margin of safety? Okay, so 6,500 minus 5,000. In a formula form, let's use their names. So in short, margin of safety simple means the budgeted unit minus what break even. So margin of safety is your budgeted level of activity minus break even level of activity. That is all. So if you know that this paper is very difficult, then if you are learn extremely hard and put safety inside. Good. So that at least if they mark your break-even point of 50 PA, you will get. Or if I did say break-even, you will not pass it, you will not fail. So as that you not pass two skills and then fail to miserable. So like let's say 51 or just to break-even pass. Put margin on it like 5 marks so that you can score 55. So let's go. Now you can express break-even as a percentage. We have it 3 forms. So this 1,005, I can divide it by this, or I can divide it by this, and then I'll get my percentage. So let's look at them. You can write margin of safety in 3 folds. Number 1, in terms of unit. Number 2, in terms of sales value. Number 3, as a percentage. Each of them have its own formula. As a percentage, no shortcut. So these are the 3 sections of break-even that we have. So unit, what's the formula? So let's look at the formula. Unit is equal to budgeted unit minus break-even unit. That is all. Sales margin of safety in terms of sales value is equal to the margin of safety in unit times what? The selling price. For now, anything you want in value is the unit times what? The selling price. That is it. Now, as a percentage, it's equal to the budgeted units minus break-even units, all divided by what? The budget. All divided by budget times 100. Okay. Let's go down a little. What to see? So it's equal to the budgeted units minus break-even units or divided by budgeted unit times 100. That is as a percentage. Now, this budgeted unit minus break-even unit. What's the name do you give it to it? Margin of safety in terms of what unit. So as a percentage, I can just tell the examiner that is equal to margin of safety in terms of units all divided by what? The budget. The budgeted unit times what? 100. That is all. Times 100. That is all. Okay, so that is it. So here too, let's assume that the budgeted unit is 7,500 units. Determine the margin of safety in all the 3 levels. Let's start work. Suppose that the budgeted level of output or the budgeted unit is 7,500. The budgeted unit is what? 7,500. Determine the margin of safety in the 3 levels. 1 unit, 3 value, and 2 value, 3 and as a percentage. Okay, so margin of safety in terms of what? Units. If the company budget to produce what? 7,500 units. And again, the margin of safety in terms of sold value and as a percentage. Yes, so our question remains the same. Selling price 25%, the variable cost 20, fixed cost 25,000. Everything remains the same. Okay, so in this case, if I should just follow this formula, the budgeted unit is 7,500 and it's break even of 5,000, giving 2,500 units. Then over here, this 2,500 units times 25 cities, that's the selling price. Then over here, I'll go by this approach. I'll go by this, which is the 2,500 divided by 7,500 times 100. 33 1/3%. So we are done. Now let's go to the last aspect of the game to end the show. Last aspect of the game. The last aspect. Now we are going to look at for what we call contribution to sales ratio. Contribution to sales ratio. Contribution to sales ratio. We call it contribution to sales ratio. In short, we also call it profit volume ratio. So this one, the same will be like this, CS ratio. And this one to be PV ratio. They are what? The same. Contribution to sales or profit to what? Volume. The formula is equal to the contribution all over sales times 100. That is all. Contribution over sales times 100. Here you can make it contribution over sales or Can also be contribution per unit over selling price times 100. Good. So for this question, how do we get it? What's the contribution? We had 5. What's the sales? 25, right? Times 100. And that will be equal to 5 over 25 times 100. That's 20%, right? Okay, now if the CS ratio is 20%, then it means that the variable cost to sales ratio is what? The other half, or the other percentage to add up to 100. So the cost of, that's the variable cost to sales ratio will also be what? 80%. That is what means. This is an important ratio that we should take into consideration. Good. Although I did not see it last sitting, the CS ratio is nothing by your contribution over sales times 100. So therefore, the variable cost to sales ratio will also be 80%. If you like, let's calculate this. You get 80. Take the variable cost. This person, the variable cost is what? 20%, right? Divided by the sales times 100. This will give us 4 over 5. So that will give us 80%, which is the same. So as long as you know the CS ratio, you don't need to worry yourself to calculate all this. Just take it from 100, and that's all. Now, this ratio help us to determine variable cost when it's not given. Help us to determine contribution when it's not given. But it helps us in so many ways. Okay. Now, how do you find break-even sales value? We said that break-even sales value is equal to the break-even times the selling price, right? There's an alternative formula. So as soon as you know the CS ratio, we can also use the CS ratio to calculate the break-even sales value, and also use it to calculate the margin of safety in terms of value. Also, you can also calculate the break-even and target profit. Okay, so we know that this one is CS ratio. We know our CS ratio. So let's use it to calculate our break-even value. So break-even sales value, alternative formula is equal to the fixed cost about the CS ratio. That is all. So let's see if you get the same answer that we had. What is the fixed cost here? Still 25,000. I'm not changing original question. What's the CS ratio? 0.2. What's the answer? So this answer will give us 125,000, which is the same as the answer that we had for that of the 5,000 times 25. Then we had 125,000. Agreed. Basically the same. Okay. Now let's move on to the second stage where we can use the CS ratio. The next one is where we are looking for the unit required. Now we can ask you to find the sales revenue required, sales value required to earn a target profit. If it is just the unit, or we tell the examiner that the fixed cost plus the target profit about contribution per unit. Great. Now, once you're looking for value, sales value, if you divide that item by CS ratio, to give the sales value. So here, the formula will be the fixed cost, so plus the target profit or divided by the CS ratio to give you the value straightforward. Yes. And that is the end of the game. On that note, we are done with the formulas with the break even for the first set. We'll come again with the second set and then zoom into the question solving. Now let me give a trial work and then okay, before the trial work, I have to illustrate on a graph how the break even look like on a graph. Just that for the professional exams, we don't mostly ask for the graph. We've asked it between 2015 to date. We've asked it once. Good. The graph look like this. So this is the level of total cost slash total revenue slash what? Total profits, all of them. This is the output, the volume or output. Okay. Now let's just demarcate. First of all, fixed cost. If your fixed cost is 25 somewhere here, this is the fixed cost. Name it FC. Fixed cost. Goes like this. Now you can also do this way. Can just label. In this case, our fixed cost is 25. Let's label. Yes, 50. Let's just label. Yes, 5,000. Let's just label. Yeah, could be 3,000. Not done to scale. There could be 6,000. There could be 9,000 units in that order going. Okay, so the next one is we have to look for our total revenue. Our total revenue. Our total revenue will start from somewhere, something like this, total revenue. So when you produce 3,000 or 1,000, what will be the sales revenue? The sales revenue will be the 25 cities times that figure. Then you plot it. It will give you a straight line. So you just draw the line like this. Let me go. Name it total revenue. Please. The total revenue start from here. Start from the 0 points. Okay. Then go to your total cost. Total cost also start from here, where the fixed cost also start from. That's where the total cost starts from. So you go. Gone. Something like this. Then total cost. So all this section is called loss area. This is loss. Where the total cost is more than the total revenue. So we are going to, your revenue is below your cost. We are going wherever the meets. This section is what we call break even. This is a break even point. You trace it here. This is called break even point here. This point is called break even point. However, what is the budget? We budgeted for 7,500 units, right? Let's locate it here. This is 6,000. If I'm not going to scale, we just selected 12,000 like this. These are the units. Okay. Now you realize that the margin of safety hits 7,500. The margin of 7,500 is somewhere here, right? 7,500 somewhere here. This is the budgeted level, budget. Now, the distance between the break-even and the budget is called margin of what? Safety. Agreed. Perfect. Margin of safety. Now this figure is called break-even sales value. This is a break-even units. Break-even what unit, and this is a break-even point. This at the point there must be a value and there must be a unit. So next time when examiner asks you what is a break-even point, they're asking for two items: the unit and then the value. This is a break-even. Here is a profit area from here going, where the total revenue starts to increase. This is a profit area because now the revenue is more than the cost. How we get it? So now the company begin to make some profits going. So that is it. We are done with the structure. Let me give a trial work from the handout. Then we look at this. So question 1, question 2, you are doing everything. Question 3, 2, you are doing everything. So 1, 2, 3, and yes, 1, 2, 3, and 4. That's all. We are doing question 1 to 4. Try all of them. Okay, so now note, this is how far the good Lord bring us. Now note, we'll meet again. Kindly subscribe the page if you have not done that. And make sure that you go through all the outstanding videos for our next lecture. And then my sisters. Thank you. Have a nice day.